Ever felt that pang of excitement mixed with a touch of overwhelm when you finally decide to pursue that big goal? Maybe it's furthering your education, tackling a home renovation, or even consolidating debt to breathe easier financially. You've done your research, you know what you want, and then comes the inevitable question: how are you going to fund it? That's where loan marketplaces like LendKey often enter the picture, promising a streamlined way to connect with various lenders and explore your options. But before you dive headfirst into applications and interest rates, there's a crucial first step: understanding if you even qualify. Now, LendKey itself isn't a direct lender. Instead, it acts as a platform that partners with a network of banks and credit unions. This means that while LendKey sets some overarching criteria for using their platform, the specific eligibility requirements for the loans you see will ultimately be determined by the individual lending partners. However, based on common practices within the lending industry and information publicly available about LendKey and its partners, we can piece together a comprehensive understanding of the typical eligibility requirements you'll likely encounter. Let's break these down into key areas. 1. Creditworthiness. Your financial report card. This is arguably the most significant factor in any loan application, and LendKey is no exception. Lenders want to see a strong track record of responsible financial behavior, and your credit report is the primary document they'll use to assess this. Credit score. Your credit score, often a FICO score, is a 3-digit number that summarizes your credit history. While specific minimum scores can vary between lenders on the LendKey platform, you'll generally need a score in the good to excellent range. This typically means a score of 670 or higher. A higher score indicates a lower risk to the lender, increasing your chances of approval and potentially securing more favorable interest rates. Credit history. It's not just about the score. The length and quality of your credit history matter too. Lenders prefer to see a history of several years of responsible credit use, including on-time payments on credit cards, previous loans, and other financial obligations. A thin credit file, meaning you haven't used credit much, or a history of late payments, defaults, or bankruptcies will significantly hinder your chances of approval. Credit report review. Lenders will thoroughly review your credit report for any negative marks, such as collections, charge-offs, foreclosures, or recent inquiries. The presence and severity of these issues will play a significant role in their decision. Multiple recent inquiries can also raise red flags, suggesting you might be desperately seeking credit. 2. Income and employment. Demonstrating repayment ability. Lenders need to be confident that you have the means to repay the loan. This is where your income and employment history come into play. Stable income. You'll typically need to demonstrate a stable and consistent source of income. This usually means being employed full-time, although other forms of regular income, such as self-employment income, with sufficient history and documentation, investment income, or retirement income, may also be considered. Income level. While there isn't usually a specific minimum income requirement stated by LendKey itself, the lending partners will assess whether your income is sufficient to comfortably manage the loan payments along with your other existing financial obligations. They'll look at your debt-to-income (DTI) ratio. Debt-to-income (DTI) ratio. This is a crucial metric that compares your total monthly debt payments, including the new loan payment, to your gross monthly income. Lenders prefer a lower DTI, as it indicates you have more disposable income available to meet your financial obligations. Specific DTI limits will vary by lender. Employment history. Lenders generally prefer to see a history of stable employment. Frequent job changes within a short period might raise concerns about your ability to maintain a consistent income stream. If you're self-employed, you'll likely need to provide more extensive documentation to verify your income, such as tax returns and bank statements. 3. Loan purpose and type. The specific type of loan you're seeking through LendKey can also influence the eligibility requirements. Private student loans. For student loans, eligibility often involves being enrolled at least half-time in an eligible educational institution. Lenders will also consider your credit worthiness and, If you're a dependent student, the creditworthiness of your cosigner. Student loan refinancing. To refinance existing student loans, you'll typically need to have graduated and be making payments on your current loans. Lenders will assess your credit history, income, and employment to determine your ability to manage the new loan. Personal loans. These loans can be used for various purposes, such as debt consolidation, home improvement, or other personal expenses. Eligibility will heavily rely on your creditworthiness, income, and DTI ratio. Home improvement loans. Similar to personal loans, these will focus on your credit profile and ability to repay. In some cases, lenders might also consider the value and equity in your home. 4. Other potential requirements. Beyond the core factors of credit, income, and loan type, there might be other eligibility criteria to consider. Age and residency. You'll typically need to be a certain age, usually 18 years or older, and a legal resident of the United States. Citizenship or visa status. For some loan types, particularly student loans, your citizenship or visa status might be a factor. Cosigner. If you have a limited credit history or a lower credit score, you might be able to improve your chances of approval by having a creditworthy cosigner. The cosigner essentially agrees to be responsible for the loan if you default. The cosigner will need to meet the lender's eligibility requirements as well. Loan amount and purpose restrictions. Lenders may have minimum and maximum loan amounts, and they might have restrictions on how the loan funds can be used. Understanding these general eligibility requirements will put you in a much better position as you explore your loan options through LendKey. By knowing what lenders typically look for, you can assess your own financial situation and make informed decisions about whether applying for a loan through their platform is the right step for you. With that said, thanks for watching, and until next time.